Okay, so you have particulars, and for the amount column, we have existing and proposed, two amount columns. So whenever we prepare an income statement and we find what is happening to the profitability, we always start with sales. Now understand this question first. The company is trying to relax its credit standard. So they're asking, should the firm relax its credit standard? And if yes, what would be its impact is what we have to tell. Okay, so we have to give a reason as to why we are asking them to relax. So we'll start preparing income statement. Along with it, I'll also show you one or two working notes also which are important. A firm is currently selling a product at rupees 10 per unit. The most recent annual sales were 30,000 units. So as yesterday I told you, whenever we prepare an income statement, we always start with sales. So they are telling that they are selling 30,000 units at rupees 10 per unit. So 30,000 units into rupees 10 per unit, if you do, the sales will be 3 lakh. This is the existing sales. As of now, the company is selling this much. Any doubts still here?
No, ma'am.
Now here you see this sentence which I am highlighting. The firm is thinking to relax credit standard and expects 15% increase in the units sold. So by relaxing the credit standard, by giving credit to more number of people in different categories, the firm is thinking it will increase its sales by 15%. The units sold will increase by 15%. So here I'll show you in the next column. Already we have 30,000 units which the firm is selling. Now it will increase by 15%. So plus 15% of 30,000. So by 15% of the original sales, whatever you're selling, it will increase. So 15% of 30,000 is 4,500. So 30,000 plus 4,500, the new sales would be 34,500 into 10 rupees per unit is the selling price. So the proposed sales will be 3,45,000. Any doubts in this? Is that clear, everybody?
Ma'am, why we have to multiply again into 10?
Because this is number of units, 34,500 units it is. See here, this was
Okay, ma'am.
30,000 units. So I have taken 30,000 units and added 15% to it. And in the question also you can see it's given 15% increase in the units sold. So it is in the units sold increase, and that's why I'm adding it. Is that clear?
Yes, ma'am, got it.
Any other doubts, anybody? So we have existing sales and we have proposed sales. Okay, let's go to the next thing. That is, from sales we minus the variable cost first. So I will do less variable cost. Okay, what is variable cost values given? Let us see. The variable cost per unit is rupees 6. So 6 rupees per unit is variable cost. We have the number of units. For existing, the number of units are 30,000 units. Into, we have to multiply it with 6 rupees per unit variable cost value. So 30,000 into 6, you will get 1,80,000. And for the proposed, you have 34,500 units, which we have calculated about 15% increase in the number of units. So proposed will be always now 34,500 units into 6 rupees is the variable cost. So if you multiply, you will get the total variable cost as 2,07,000. Now from the sales, when you minus the variable cost, you get contribution. Or you can also call it as gross profit, but in the income statement, it is always called as contribution. So we have to minus sales minus the variable cost to get the contribution value. Here is the formula. 3 lakh minus 1 lakh 80,000, you'll get 1 lakh 20,000. In the proposed case, 3 lakh 45,000 minus 2 lakh 7,000, you get 1 lakh 38,000. So this is the contribution. From the contribution, next we deduct the fixed cost. So we'll write here less fixed cost. Okay. Now can anybody tell me what should be taken as fixed cost? They've given here actually the total fixed cost is rupees 60,000. So here I will take 60,000 for existing. What should I take for proposed? Can anyone give it a try?
The same, ma'am.
Yeah,
Or
because same reason. Reason is the name itself. It is fixed cost. Fixed remains fixed. It will not change with increase in sales. Even if you produce more, fixed cost will not change. Only variable cost will change. If you produce less, still fixed cost will not change. So fixed cost remains fixed. It doesn't change with the number of units sold. Is that okay?
yes, ma'am.
So we're
Yes,
taking
ma'am.
fixed cost 60,000 same for both. From contribution, when you minus fixed cost, you will get EBIT. Now in this problem, if you see carefully, they have nowhere given bad debts. Here, see, no change in the bad debt expense. That means they have not told us what are the existing bad debts, nor we know the new bad debts. So bad debt thing has not been given. That's why I'm directly finding the EBIT. If bad debt was given, I would have done less fixed cost, less bad debts, and then found the EBIT. Okay. So here it's not given, so we are directly finding EBIT. So contribution is 1,20,000. From that I minus 60,000 rupees, which is fixed cost. So my EBIT will be 60,000 remaining. Then contribution of 1,38,000. From that, when I minus 60,000 EBIT, sorry, fixed cost, I get EBIT of 78,000. Okay, so this is the value of EBIT. Now next we will minus tax. It is earning. What is EBIT?
Earnings before interest and tax.
Earnings before interest and tax. Here we don't have the interest thing as of now. So we're not taking that into account, but we have tax, so we will do less tax. And now we'll see what is the percentage of tax given in the question. Nothing is mentioned about tax. If you see, the required rate of return is 15%. Should the firm relax the credit standard, additional working capital. So nothing on tax is given. Therefore, I'm taking it as nil, 0, because there is no tax rate given in the question. If it was given 40%, I would have calculated 40% of EBIT, that is 40% of 60,000 and 40% of 78,000. It is not given, so I'm taking it as 0. So when you less tax, you will get earnings after tax, EAT. So from EBIT, it becomes EAT, which is 60,000 and 78,000. Okay, till here, any doubts, anybody?
No, ma'am.
Okay, now what we will do is, I will show you the working note on how to find the cost of additional investment. I don't know how many of you have revised and remember the formula yesterday. There was, after we did, I'll show you the format I showed you here, right? Yesterday, sales less variable cost, less bad debts, then you get profit before tax, then you less tax, you get profit after tax. And after that, we less cost of additional investment. This is nothing but delta K into delta I. Remember in the formula? Sorry. Yeah, it was K into delta I only, no? Yes.
Yes, ma'am. K into delta I.
So that K into delta I is nothing but this cost of additional investment. So that we have to less here now. So we'll write less cost of additional investment. So for this, we need to first find the additional investment and then multiply the percentage given to find the cost of additional investment. So here, if you see the formula, they've given you the required rate of return is 15%. But 15% on what? On additional investment. And how much is the additional investment is not given. So we need to find it. So how to find the additional investment? Formula method, if we do, this was the formula. Delta S divided by 360 into average collection period into V. But here we are doing tabular way, so there is a little change in the formula. I will show you that new formula, what we have to take. So you write working note on additional investment. And the formula is additional investment is equal to cost divided by debtors turnover ratio. You need to do cost divided by debtors turnover ratio to find the additional investment. So first we need to find the debtors turnover ratio. Debtors turnover ratio is equal to $360 divided by average collection period. I am writing it as ACP, that is nothing but average collection period. So these are the two formulas which are very important, which we will see and find the additional investment. So let us start solving it with the formulas. So you'll have to again do existing and proposed, because we need additional investment in both the cases. So let's start. First, we'll find the debtors turnover ratio. I will call it as DTO. That is nothing but the debtors turnover ratio. You can also call it as DTR. So the formula, as you know, is nothing but 360 divided by average collection period. Let's go to the question and see what is the average collection period. The average collection period would increase to 45 days. See here, first average collection period is 30 days. And now it is increasing to 45 days. So these are the two average collection periods that we have to keep in mind while solving. The first one given 30 days is the existing average collection period. As of today, you give them 30 days time to make payment. And after you relax your credit standards, the average collection period has increased to 45 days. So some of the customers are paying you after 45 days. So this 30 days is existing and this 45 days is proposed. Any doubts, anybody?
No, ma'am.
No, ma'am.
So here we will do 360 divided by 30 days in case of existing, which is equal to, if you do 360 divided by 30, you get it as 12.
12.
So this is 12 times. The turnover ratio, remember ratio analysis, when I was teaching you, I told you all the turnover ratios, whether it is stock turnover, debtors turnover, inventory turnover, all the turnover ratios will be in times. So that means the debtors are turning over 12 times in a year. So I will get my money 12 times in a year. 30 days means on an average 1 month. Okay, then for proposed, we'll do 360 divided by 45 days because the new average collection period is 45 days. So when you do that, the debtors turnover ratio will be 8 times.
8.
So here, when it is 45 days, you're getting your money only 8 times in a year. So you're getting it late by 15 days every time. So now we have debtors turnover ratio. We can find the additional investment. This is the formula. Cost divided by debtors turnover ratio. Okay, now what to take when I'm talking about cost and how to solve it. See, there are two ways to do it. One is you can add your variable cost and fixed cost and take that. So I'll go to the problem. Okay, in the existing, see what is the variable cost. 1,80,000 and 2,70,000. Sorry, 2,07,000, and see what is the fixed cost. So you simply add both 1,80,000 and 60 and 2,07,000 and 60. You will get the total cost. That's what we mean by cost, the variable cost and the fixed cost. If you don't want to do it that way, another way is in the question they have given you something called as average cost per unit is 8 rupees. So you can do 30,000 units into 8 rupees for existing and 34,500 units into 8 rupees for proposed. So this is how it will work. Sorry, in the proposed you will have to do 30,000 into 8 plus 4,500 into 6, because when you increased your sales, your fixed cost didn't increase. See here, I will just show you what I'm trying to say. Okay, in the first case, you sold 30,000 units. 30,000 into 8 you can do, because 8 rupees includes your fixed cost also, so you will get a value. In the second case, you can do 30,000 into 8. This is the total cost which was there previously, plus new sales that you made, that is additional sales that you made were only 4,500 units, into for additional sales your fixed cost didn't increase, so you need not take 8 rupees, you should take only 6 rupees, which is the variable proportion. So this will be for existing 30,000 into 8, which includes variable cost as well as fixed cost. This 8 rupees includes 6 rupees variable cost and 2 rupees fixed cost. In the case of new, 30,000 into 8, which was there already existing, plus the new sales that have happened is 4,500 units into only the variable cost, that is 6 rupees. Because of new sales, your fixed cost didn't increase, fixed cost remains fixed. So this is another way to do it. So you want me to show it this way, or you just simply want to add the variable cost and fixed cost?
Add the variable cost and fixed
And
cost.
variable plus
All of you want to add the variable and fixed, right?
Yes, ma'am.
Okay, so let's do it in that way. So here we will write down. In the first case, the variable cost existing is 1,80,000 and fixed cost is 60,000. So I will 1,80,000 plus 60,000. First we add, this is our total cost, and we have to divide the total cost with the debtors turnover ratio. In the existing plan, what is the debtors turnover ratio?
12 times.
12 times. So we will solve it now. 1,80,000 plus 60,000 divided by 12.
20,000.
So the answer that you get is 20,000. So 20,000 is your additional investment in the first case. In the second case, the variable cost is 2,07,000. That is the proposed plan. Plus the fixed cost remains fixed, that is 60,000. Divided by the debtors turnover ratio is how many times?
8.
So 2,07,000 plus 60,000 is 2,67,000. Divided by 8, you will get 33,000.
3,375.
375.
375. So this is your additional investment. Any doubts?
No, ma'am.
Now we need not take the additional investment in the solution. We have to take the cost of additional investment. So here I will write here it's already written, see, less cost of additional investment, which is nothing but in the existing plan, the additional investment is 20,000 into the cost which is given in the question. See here, the required rate of return is 15%. That means this is the cost of your investment. So 15% we are going to calculate of 20,000. How much you get?
3,000.
3,000 is the cost of additional investment in the existing plan. Then in the proposed plan, your additional investment is 33,375 multiplied by 15% again, because that is the cost of additional investment. So how much you get?
5,006.25.
You take it as 5,006 rupees, round it off. If it was 5,006.5, I would have taken 5,007 rupees. Okay, so this is the cost of additional investment. It is a very important working note. Do you have any doubts in this?
No, ma'am.
Okay, so now what we will do, the only thing remaining, we've completed the entire sum. The last line they have told, it is also assumed that increased sales will result in additional working capital of rupees 10,000. So additional working capital is as good as additional investment. So we cannot take full working capital. We have to take cost of working capital. Like we took here cost of additional investment. We didn't take 20,000, 33,375. We took only the cost of it. Same way, we will take the cost of additional working capital. So here you write less cost of additional working capital. How much is the additional working capital given? 10,000. 15% of that you find. That comes to 1,500. Where should I take? In the proposed, not in the existing, because they have clearly mentioned here, it is also assumed that increased sales will result in additional working capital of 10,000. Where has the sales increased, in the existing or in the proposed? Are you all there?
Yes, ma'am. Proposed.
In the proposed, the sales has increased. So only when the sales will increase, there is additional working capital, and therefore I have taken only in case of proposed. In the existing, I have taken it as 0. Did you understand the logic?
Yes, ma'am.
It is clearly told here, it is assumed that increased sales will result in additional working capital. So increased sales part is in the proposed plan, so I have taken it there. Now see, you have to less both these costs, cost of additional investment and cost of additional working capital. Once you less both, you will get the profit, or you can call it as earnings. So now from 60,000 I have to minus 3,000, I'll get 57,000. And from 78,000 you should minus 5,006 and 1,500, you will get 71,494. Okay, so this is your answer. Now tell me, should we go for the proposed plan? We should relax the credit standard and sell additional 15% or no?
Yes, ma'am. We need to relax.
We need to relax. Why? Because our profit has increased. In our existing plan, our profit was 57,000. But when our sales increase, our profit is increasing to 71,494. So the profit has increased. It has a positive impact on the profit. Therefore, we need to go for it. If this would have decreased, if this was 40,000, then I would have not gone for proposed plan. Or simple way, see both the numbers, existing plan, proposed plan, which is highest? The proposed profit is highest. So we need to go for the proposed plan. That means we need to relax the credit standards. Did you understand this problem?
Yes, ma'am.
Yes, ma'am.
So tabular way, you have to do it like this. And if it is formula method, yesterday I have done 2 sums and shown you how to do it. Okay, so we'll do one more sum, the tabular way, and then we'll go to the credit period part of it, which is the next. I told you totally we are going to solve on 4 things: credit standard, credit period, cash discount, and collection efforts. So I'll do this sum and I'll finish credit standard. These are the only different types of variations you will get in credit standard. So if you solve these 6 sums, any kind of question that comes in exam, you will be able to do. The numbers will change, but the content almost will be same. So we'll do this one sum, and then if time remains, we will go to credit period also. So let's start. So the second problem that we have to do, a firm is currently selling a product at rupees 8 per unit. The most recent annual sales were 32,000 units. The variable cost is 4 rupees and the average cost is 6 rupees. They've given you the total fixed cost and the average collection period. The firm is thinking to relax the credit standards and expect 20% increase in the units sold. So first we will find the value of sales. As of now, the firm is selling 32,000 units. So we'll write here sales into bracket 32,000 units into what is the price per unit? It is sold at 8 rupees. So 32,000 into 8. How much you get?
2,56,000.
2,56,000 is the sales for the existing. In the new, they are telling that your sales will increase by 20%. That is, the number of units sold will increase by 20%. So 32,000 units plus 20% of 32,000. That means on the original you add 20%. So how much you get? 32,000's 20% is 6,400 plus your 32,000, 38,000.
38,400.
38,400 units into the selling price is 8 rupees per unit. So 38,400 into 8, if you do, you get 3,07,200.
200.
So this is what is the sales value. Any doubts? Okay.
No, ma'am.
Next, what we do, we less the variable cost, and they have told you the variable cost is 4 rupees per unit. So we will take that. We'll write here less variable cost. In the first case, we have 32,000 units into 4 rupees per unit is the variable cost. So 32,000 into 4, you get 1,28,000. And in case of the proposed plan, your sales are 38,400 units into 4 rupees variable cost. So 38,400 into 4, you get 1,53,600. So now once you minus sales minus variable cost, you get the contribution. Sales minus variable cost. So 2,56,000 minus 1,28,000. You get 1,28,000. And 3,07,200 minus 1,53,600. You get 1,53,600. From this, we have to less fixed cost. Let's see what is the fixed cost given. They've said the fixed cost, the total fixed cost is rupees 30,000. So we have to minus 30,000 fixed cost from both the cases. Fixed cost remains fixed. It is not increasing with the increase in sales. If they mention in the question that you have to increase it, then we will increase. Nothing is mentioned, only fixed cost is given, so we'll keep it same. Okay, so when you less fixed cost, you get the EBIT, which is nothing but the earning before interest and tax. So 1,28,000 minus 30,000, if you do, you will get 98,000, right?
Yes, ma'am, 98,000.
And 1,53,000 minus 30,000 is 1,23,600.
23,600.
So this is your EBIT. So from again in the question they have not mentioned anything about bad debt. That's why I'm not taking, and I directly found the EBIT. If bad debt was given, remember the format from after variable cost we less the fixed cost and then we less the bad debts. So here after fixed cost I'll have to do less bad debts. Okay, so EBIT we have got, we'll do less tax. And I think even the tax rate is not given, similar kind of sum. It's not mentioned, so we will write it as 0, 0. So you will get earning earning after tax, same 98,000 and 1,23,600. Now the next step is to find the additional investment. So to find the additional investment, what do? We first find the debtors turnover ratio. Yeah. So here existing and proposed debtors turnover DTO is equals to 360 divided by ACP, that is average collection period. So in case of existing plan, what is the average collection period given? 40 days. And in case of new plan, they have said it would increase to 60 days. So existing we have to take 40 days, 360 divided by 40. How much you get?
9.
Equals to 9 times. And for the proposed 360 divided by 60 it was, right?
Yes, ma'am.
That
Yes,
is equal
ma'am.
to
6 weeks.
6 times.
6.
Okay, so now we'll find additional investment, which is equal to cost divided by debtors turnover ratio. And how we find the cost? I'll write it here in the bracket for you. Cost is equal to fixed variable cost plus
Fixed cost plus variable.
So now we'll add both. 1,28,000 is variable cost and 30,000 was fixed cost. So 1,28,000 plus 30 is
58,000.
1,58,000 divided by debtors turnover ratio is 9 times. So 1,58,000 divided by 9, 17,000.
555.
556 I will take it because it's 555.55. So I'll round it off. Then in the second case, 1,53,600 is the variable cost and 30,000 is the fixed cost. So it comes to 1,83,600 divided by 6 times. You get it as
600.
30,600. So this is the additional investment. Now we will find the cost of additional investment. Which is nothing but whatever investment you have got, 17,556 into the rate which is given. So here the rate is 12%. So we'll use this 12% rate into 12%. 17,556 into 12%, you get 2000.
106.7.
106.7 it is, so I've made it 107. And for the proposed plan, it is 30,600 into 12%. How much you get?
3,672.
3,672.
672.
672. So this is the cost of additional investment which we need to less. So here you will get your profit. So from 98,000 minus 2,107, you get 95,893. And from 1,23,600 minus 3,672, you will get 1,19,000.
922.
928.
928, ma'am.
So
Yes,
now
ma'am.
these are the profit values. Can anybody tell me we should go for existing plan or proposed plan? Proposed plan, because the profit has increased. Earlier it was 95,893. Now it is 1,19,928. So increase in sales is leading to increase in profit. Therefore, we should go for the proposed plan. Is that clear? Any doubts with these sums?
No, ma'am.
All the tabular sums that we will do will follow the similar pattern. So I am solving only two sums for credit standard. Okay.